That takes us to adjusting journal entries. Most of our problems in accounting deal with getting things in the right year. You want to make sure your expenses for 2017, for example, are all showing on the 2017 income statement. So you're not going to make a journal entry every hour somebody works for you, but at the end of a year, you want to make sure that all the wage expense for all the hours worked are showing up in 2017, not spilling over to when you pay the person probably in 2018. So that's what adjusting journal entries are all about. And they really do take some thought as to how you make sure you have everything correct on your income statement and balance sheet.
So when should revenues and expenses be recognized? We generally record revenue when it's earned, which means when the goods are delivered. So in the case of Macy's, that's when the customer walks out with the merchandise or when services are performed. So if I'm a plumbing company, it's when I actually do the plumbing services. Notice that's not necessarily related to when the cash is received. In the case of Macy's, the customer could pay cash or put it on the credit card. Doesn't make any difference. It's earned when they walk out with the goods. Same thing with services. We don't care if they pay a down payment or they pay afterwards. We recognize the revenue when the services are performed. Expenses then are just the flip side. So when the goods are received or the services are received, that's generally when you record expenses. Those two rules are a little bit more complicated, but for what you need to know right now, that will suffice. So adjusting journal entries are just making sure that our accounting records are up to date. We don't really care if we record something on a Monday or a Tuesday, but we do want to make sure the end of the month or the quarter or the year are correct. So are the assets and liabilities up to date? If we have a whole lot of office supplies as an asset, are those really still on hand? Are there any things that we owe people, like wages, that we haven't paid yet? Similar to office supplies, did we prepay some insurance that's really good for a year and we've used up some of that time period, so that's not all an asset anymore? We also want to make sure our income statement's up to date. And so do we have any interest income, for example, that we haven't recorded yet? And looking at those balance sheet items, if we've used up some office supplies, I must have some supplies expense. I might have some wage expense or some insurance expense that belongs on the income statement. So we'll just run through some examples. We're going to do a plumbing business again. So let's say we bought 15 boxes of paper during the month. They were $20 a box, so that's $300. At the end of the month we look and we've only got 10 boxes still on hand, so we must have used 5 boxes. So we should have some office supplies expense at 5 times 20 or $100. And that's because we no longer have the office supplies, so we want to reduce that asset by 100. So if we think about the income statement, now we've got $100 of expense. Those are our 5 boxes times 20. And if we look at the assets, we had 300 in office supplies, now we have 200. So on the balance sheet, we've got those 10 boxes at 20 of 200. That really should be the asset value. Should make perfect sense. So example 2, we've got some salaried employees. They work 5 days a week, paid $5,000 every Friday. The month ends on a Tuesday. So they've worked, but we haven't paid them yet. So we've got some salary expense for those 2 days, 1,000 times 2 days, for $2,000. and we haven't paid them, so we must have a liability for that same $2,000. So adjusting journal entry number 3, same plumbing business. We have a customer that owes us $50 in interest on an overdue account. They plan to pay us, but maybe they're waiting for their tax refund, for example, and they'll pay our bill along with the interest. Our adjusting journal entry will be, I'm going to do this kind of upside down because interest revenue is the easiest one to visualize. So I've earned some revenue because of this account, and so that's a receivable because the customer is going to pay that to me. So I have an asset as well as some revenue that needs to be booked in this fiscal year. That takes us to depreciation. Depreciation is an adjusting journal entry that every company is going to have. And like so many of the things we've talked about, depreciation is a term that we use very differently in accounting than people will use when using it in casual conversation. If you remember office supplies, when we bought the paper, we expensed the paper as we used it up. We're going to do the same thing for our long-term assets, but as we use it up, we call it depreciation expense. It's just expensing that original cost as you use it up. It's not estimating the value of the asset. So it's not the same as when the car dealer tries to sell you a used car, because that new car depreciates in value by 40% the minute you drive it off the lot. That's not what we're doing. All we're trying to do is take that original cost and move it to the income statement, expense it in some reasonable way over the life of the asset. So normally we just estimate the life of the asset, divide that original cost over that period, and expense a little bit of it each period so that by the end of the life, the asset value is down to 0. The accounts used then, the nice thing is they're always the same. You debit depreciation expense, credit accumulated depreciation. Accumulated depreciation is a little different kind of account. It's a contra asset account, meaning it belongs on the balance sheet under the asset side, but it has a credit balance. It's a negative asset. The only reason we do that is, for some reason, we just want to keep the original cost of the asset on the books, and so we use this accumulated depreciation account to determine the total depreciation on the asset to date. So to see how that's going to work, let's say we had a building that has a 10-year life and the company owned it for 3 years. The building cost $500,000, so that's the amount that stays in the building account. But each year we take $50,000 and we depreciate it. So at the end of 3 years, we'd have a total of $150 in that accumulated depreciation account. So the net building is $350. Again, we just make up that accumulated depreciation because we just want to know what that original cost is at all times. So let's say we bought an automobile on the 1st of December this year. The car should be used for 60 months. So our adjusting journal entry is depreciation expense for 1 month. 30,000 divided by 60 is 500 a month. And then we have accumulated depreciation auto for that $500. And we would do that every month for the next 60 months. Now it's your turn. Let's see what you can do.